We are set to kick off our scenario planning in times of disruption webinar. We will be recording this webinar, so we'll also be sharing it with everyone. But to get things started, I would like to welcome everyone to today's webinar, Scenario Planning in Times of Disruption. I hope everyone on this webinar is healthy and happy and adjusting to the new norm. My name is Mike Moody. I manage sales and business development at Carlson Management Consulting. Many of you received an invitation from myself or a member of our team to attend today. Thank you very much for joining us. Greatly appreciated. We have a lot of important content for scenario planning. But before we get things started, I would like to let everyone know that we will have a question and answer session at the end of the webinar. If you do have questions during the presentation, please note the Q&A section at the bottom of your Zoom meeting screen. Feel free to enter any and all questions there during the time of the presentation, and I will be certain that they are covered during the Q&A session on the back half of the webinar. I will note today's webinar is being recorded and will be sent to all attendees. If you have any colleagues who you think would benefit from the session, feel free to forward it along. Contact information will be available at the end of the webinar if you have any follow-up questions or would like a personalized demonstration or conversation. As for today's agenda, we'll be covering introductions, Carlson overview of Carlson Management Consulting, an Alike company. We'll be doing a demonstration where Tiffany and Dallas will be covering challenges of scenario planning in times of disruption, scenario strategies our clients are employing, and of course, best practices in scenario planning. And as mentioned, we'll wrap everything up with summary, key takeaways, and a question and answer session. As far as introductions are concerned, I am Mike Moody. I manage business development and sales. I've been with the organization now just about 5 years. I've spent my professional career in business development and sales and have been working with a number of other organizations. I actually see a number of individuals on the call today that I've worked with to get Adaptive in place and up and running at your individual organizations. So thank you for attending. I'm also joined by my colleagues, Dallas Moody and Tiffany McLaurin. As Tiffany McLaurin, who joined Carlson in 2018, she came to Carlson with 10 years experience in corporate finance, which includes organizations of all sizes, from Fortune 500 companies to ground floor startups, and specializes in SaaS revenue modeling, rolling forecasts, driver-based budgeting, and of course the subject of today's webinar. Tiffany's impact on our team has been immediate. In such a short time, she's over 20 implementations of Adaptive Insights, and along with her finance background and adaptive expertise, she brings a level of unmatched enthusiasm to each and every project. Dallas Moody is one of the longest standing members of Carlson Management Consulting. He is a CPA, he's vice president, and he joined the team in 2012 as, I believe, our first employee, with more than 10 years of experience as a finance and technology domain expert. Dallas is responsible for helping guide clients through the sales process, as well as manage the full cycle of client implementations. Utilizing experience he has gained as an Adaptive Insights power user and prior accounting consulting experience, he incorporates best practices in budgeting, forecasting, and planning process, as well as delivering actionable management reporting and necessary improvements to clients' models. As I mentioned, he's a certified public accountant in the Commonwealth of Massachusetts and is a certified in the implementation of Adaptive Insights with one of the highest number of implementations at Carlson Management Consulting. As far as Carlson Management is concerned, we were initially founded in 2010. Carlson's foundation lies in our customer success within our Adaptive Insights practice. We are a 7-time top partner award winner with Adaptive, most recently earning the recognition of Global Partner of the Year and Partner Excellence for fiscal year 2019. We're also one of 3 platinum solution providers with premier accreditation and the largest team of adaptive certified consultants in the world, ultimately leading to our acquisition by Alight Solutions in December of 2018 as a direct result of our commitment to the adaptive platform and the successful implementation of over 550 customers across the platform. Our success is truly an indication of our customer success, as our reputation is truly determined by each successful implementation. We have 4 offices located in Massachusetts, Vermont, Maine, Ohio, as well as overseas in the United Kingdom with a team of consultants nationwide. The key differentiator that separates Carlson from the crowd is that each consultant, much like Tiffany in Dallas, comes to our organization with a finance background as well as a deep expertise within adaptive, making Carlson the cloud financial solution expert. I would like to highlight, a cross-section of customers of varying sizes across verticals, including manufacturing, nonprofit, SaaS, life science, and beyond. We see companies struggle to quickly create multiple scenarios in a timely manner with little or no time to analyze the data. One common thread many of these organizations share when working with Carlson and scenario planning, you get powerful results through streamlining processes, creating more time for analysis, and giving companies the ability to pivot and shift between scenarios and actively plan for the future with data. Before I hand it off to Tiffany in Dallas, in addition to what you're seeing here on the adaptive slide, I would like to point out that adaptive is a solution market leader with over 5,000 customers worldwide. It continues to earn highest user rankings in G-Crowd and TrustRadius. With multi-tenant in-memory learning, adaptive is a modern cloud technology consistently being recognized by Gartner and Forrester as a leader in the space. Getting away from static planning, avoiding the confusion of multi-versions in Excel, adaptive's automation enhances productivity with timely and relevant reports, spending less time chasing data and providing the ability to make decisions faster. The insights gained improve visibility with a single source of truth, giving companies the ability to run what-if scenarios to answer operational and strategic questions, which is why we are here today. And with that being said, I would like to hand it off to Dallas to move right into the webinar.
Hello, everyone. My name is Dallas Moody, as Mike indicated. My background and Tiffany's background is very much akin to what you would find across our employee base. Roughly about 70 to 80% of our headcount have historically used adaptive in their own working life before coming aboard at Carlson, and are really they have the experience as a practitioner using the tool to solve some of the exact same challenges that our customers are typically also trying to solve. And so with that said, our topic is scenario planning in a time of disruption. And I think just by the virtue of the word disruption, it's really unplanned, but there's 2 types of disruption that you can run into. What we're going through right now with the coronavirus is one form of disruption, and at the same time, that's led to other forms of disruption for people that are doing planning that might have actually seen unanticipated periods of growth for companies such as Zoom or Amazon as a result of market conditions as they may be. The biggest thing that you typically see is that and I think what is being borne out is probably that people didn't flux scenario planning far enough when they were coming up with their plans for the current fiscal year. Granted, nobody probably anticipated the impact of coronavirus at the level it has hit us, and I think in many ways the traditional planning process assumes that the trains run on time, and that historical experience is going to also be indicative of future results, and likewise, we're not accounting, so the trains might be running on time, but we're not accounting for the fact that those empty trains are simply, or those trains are simply empty. One of the things that I looked for this article to be able to share was, it was a comparison of the trains running on time versus coconuts falling out of a tree and hitting you on the head. And, in many ways, the coronavirus was the coconut that fell out of the tree, hit us on the head, and we all had to be reactive, in our planning processes. And that's kind of what we've seen across the board. In many ways, clients are having to make some very tough decisions in light of, the coronavirus impact. I think just considering that, hopefully moving forward in future planning processes, I think people are going to be, doing a little more thought around what it's going to look like next year when they start going to do scenario flux analysis and, kind of sensitivity analysis around their numbers. So again, with the traditional planning process, it's really, ceteris paribus. If you were to think about, from an economic standpoint, trying to hold all other things constant generally is our planning process. In particular, I work with, a number of customers that are in, annual recurring revenue businesses, and you generally, assume some level of churn, but you're not assuming impacts so far reaching that, maybe wholesale, verticals such as, restaurants and retail, are being impacted at such a level that, what you thought was going to be a recurring revenue stream, and a source of, cash and billings, may not be there, within a quarter or less, in many ways. And so generally you're assuming that you're running off of a run rate, and you may not be doing any zero-based budgeting at all. And so if you're not doing, any level of zero-based budgeting, particularly around things such as like, vendor spend, or if you were to think about, in the software industry, when you're thinking about, maybe what it looks like on your own internal software spend and expenses, then you're not, planning at a detailed level. If you're running off of a historic trend, you're kind of pinning yourself down into, what your process is going to be, and you have less levers in order to be able to impact your plan for scenario analysis. So a lot of what I'm going to talk about is one, and what we're going to demonstrate is the ability to plan at a detailed level inside of Adaptive, and then how you can actually flex that budget based off some flags and things that you can apply in Adaptive. You could apply it in another system, or you could apply it inside of Excel. It's all about how you drive that through your model. And then, the other thing that you typically see is, what does top-down planning look like, and pressure testing. So what are the drastic scenarios that you should try to be modeling? What happens if I have a 50% revenue miss, or if I have the same revenue numbers, but I see a rapid decline in margin, due to expanding costs on a particular, item of my cost of sales? Or what if I have astronomical growth? How do I keep up with that? If I am the Zooms of the world, what is that doing to my head count? And do I need additional head count to fund that? Or what does that do to my P&L? And then, honestly, part of the reason we're talking today is also because we're also, adaptive partner. And, one of the biggest, pain points that you're going to run into in Excel is honestly linking of sheets and version analysis, and making sure that the associated lookups maintain, integrity through that process. In the time of adversity, and this is kind of what we've seen across our client base, when we're talking to clients about things they're trying to address, is, they're having to consider, what are they doing with their existing headcount? Are they having to do something to their model where they may have not previously accounted for it in their, adaptive or Excel models, where maybe you're assuming everybody's a full-time head, and you're having to, change that in some way to where you're moving to like a full-time equivalency. So maybe you're moving from 100% headcount to you're taking people down to, 2/3 of a head, or, what have you, as far as like what their work expectation is. We're seeing people, that maybe because of the time frame when, quarantine hit and everything, a lot of people hadn't paid out their prior year bonuses. And so we're seeing some of those getting delayed. And then, the other thing that, you have to be considerate of in this type of environment is if you're not hitting your bookings target, is making sure, one, that those targets, whatever drives your commissions performance, you're not going to be able to model all the way down to an individual level necessarily for commissions. But if you're trying to model commissions, making sure that, whatever your bookings attainment is ultimately linked into your commissions model so that you can, pick up that expense, because you may take the wrong types of actions in light of that because of slowing sales. There might be, less stringent actions required. Nonetheless, it's going to have to happen. And then we're seeing people adjusting 401k match percentages. And so ideally, all of these things are already existing in your model, meaning you have the ability to move your bonus payouts. You have the ability to change bonus attainment. And then also, typically we have global assumptions in our models to allow for us to plan, global pay increases. But there might be a requirement that you're having to do that, and take the opposite direction and do a pay decrease, as a result of what we're currently going through. And then, the other option is, and some of what we're going to talk through is how we can actually use scenario tagging inside of a model to actually be able to, maybe you do a single model. And one of the pain points that some people might experience inside of Adaptive is having to go through and delete a ton of rows or go through and adjust an end date for a large swath of the employee population. If you use like the row tagging, you can actually, do that pretty quickly through modeling. We see it not just in times of adversity. We see clients in the private equity industry doing tying kind of headcount to revenue generating activity. And I'll talk about that a little further on the next slide. But, being able to actually tie your headcount and your expense initiatives into actual revenue generating activities. And so how you align your headcount to those types of activities can be especially impactful during this, this time. The other thing that I see, and the reason a lot of companies, if they are in a cash strapped position, is actually looking at the direct cash flow methodology. And even if you're not implementing that inside of your model, maybe you're thinking about a 13-week cash flow model, and you're actually taking a detailed look at rather than thinking about balance sheet and the cash flow just from the standpoint of a days sales outstanding or days payable outstanding, things like that. You're actually looking at, what can you do to improve your cash, float. And so in that way, you might be actually looking at, what are your vendors that are absolutely required to maintain operations, as normal. And you're probably, applying some sort of direct cash flow methodology. That's going to require that you have the ability to look at your spend by vendor on the plan. So again, a zero-based budget. And then also that you're going to need to actually take a detailed look at your AP register and try to figure out, what does the timing of payments need to look like in order for you to keep business as normal. In times of abundance, and this is hopefully where we end up back at some point in time here, and I think certain industries are seeing this even right now, are you accurately reflecting maybe where your commissions tiers are? You don't want surprises based on the fact that maybe you've under forecasted your attainment, or you don't have the correct tiering inside of your model. So maybe you need to adjust things like that within your model. In times of growth, if you have aggressive bookings goals, making sure that you have the ability to identify, capacity planning gaps. In particular, if you're a heavily, sales headcount focused model, you want to be able to identify, are you having underruns in your headcount so that you can staff to that so that you can generate the necessary bookings. As a former user of Adaptive, I did a lot of this analysis outside in Excel, and moving into the implementation sphere, I immediately saw the ability and how I could have actually built some of this inside of Adaptive. I just quite frankly did not have the time, and that's where us as a partner, we would love the ability to help you. Same thing on the services side. What does that look like, and how can you, if you have revenue targets, what are the potential capacity gaps that you might have? Do you need to use outside contractors to help you deliver the associated revenue? And then I see it also on the development side, particularly around, you know, if you're thinking about a software development project, what does it look like to move something through the product roadmap, and can you do things with your development headcount and being able to analyze your headcount in such a way that you have the appropriate levels of seniority for product functionality that you're trying to build out. Things to also consider is making sure that your direct cost of sales align to your revenue. So if you're, you know, a cloud-based business and you're thinking about the revenue there, you're going to want to make sure that, you know, if there are certain things that are step functions or, you know, that are dependent upon your bandwidth or what your hosting costs might look like, so that you're capturing that and being able to maybe think through, you know, are there gating processes on your expenses? And then by doing things appropriately, you know, in the time of abundance, you have, one, the ability to reinvest in your technology platform, or, you know, to focus on, you know, continuing to grow the business, improving the balance sheet, which I think is going to be top of mind on everybody's list coming out of this. I think there's a ton of companies that are very levered as a result of, you know, the meteoric growth that we've experienced over the last, you know, few years, since really, you know, 2008. And, you know, so I think seeing some of that, you know, coming out of the previous recession, you know, now people are going to start focusing more on the balance sheet. And, you know, by also doing this, you have the ability to think through succession and, you know, promotion. Generally, when you think about best practices from a modeling standpoint, you know, in a time of disruption and just from a scenario analysis, you want to, at a minimum, consider at least incorporating a top-level model to think through, you know, large fluxes at the top level. Meaning, I had, you know, in the case of what I'm going to demonstrate today, is talk through, you know, how maybe you have a summary functional P&L that aligns to how you look at it from an external reporting view. And being able to say, take a baseline case, and within that one, in the same version, being able to apply different scenarios and just showing, you know, what the model and what the P&L might look like from that base case. And then you might also identify, based on that and my baseline balance sheet, come up with additional things that I need to consider. If my revenue pulls down, you know, what can that also, what are my other impacts? Or if my expenses grow, you know, making sure that I have the ability or that it's fluxing off of my baseline balance sheet assumptions so that it's changing my balance sheet, you know, my accruals, things like that appropriately. And, you know, by building the consideration of a more detailed scenario flagging into your model, you can actually tie headcount to revenue activities. You can do vendor-based modeling, and you can actually, you know, what you're going to see today, you know, is at a very detailed level, you know, around vendor spend and around personnel. But I've had clients that have said, hey, I want the ability to think about these types of adjustments or scenarios on top of a baseline plan. And so inside of Adaptive, we might have built a separate, you know, adjustment model where we're just capturing it at a natural account roll-up, and we're not trying to do it at every single GL account, being able to flux that way. And then, you know, really when people are thinking about how they build out their model, they should also consider, you know, a considered approach to long-term planning. And does that happen inside of Adaptive or whatever system you're using, or is it Excel-driven? In the case of Adaptive, there's an add-on called Office Connect, and maybe you're modeling, you know, maybe your baseline rolling 9 quarters inside of Adaptive, and then you're doing long-term modeling inside of Office Connect. But ultimately, it's just that you at least have a considered approach as to how you're handling that inside of the system from a modeling standpoint, particularly around scenario analysis. We're now going to move into demo, and right now what I'm going to demonstrate is just a little bit around how you can do some top-line, you know, top-level modeling inside of the system, just around some scenarios, and then I'll hand it over to Tiffany, and she'll do a more detailed demo of some scenario tagging across a model. Just give me one moment. Everyone should now be seeing a scenario planning folder inside of my adaptive instance. What I'm going to be demonstrating here is really just showing you guys what an input sheet might look like inside of my base budget, and how I can actually do that scenario analysis right inside of adaptive. So if I were to click right here, this is going to ultimately be a sheet where I might be trying to capture different modifiers across my model. In the instance of the way this is built out, it's taking all of my detailed plan that's built at the lowest level inside of adaptive, all the way down at the GL account level. And then that's being tied into this baseline scenario. And then on top of that scenario, I have the ability to model additional scenarios through this scenario dimension. And so what I have the ability to do is apply different assumptions. And so when I speak to putting large fluxes on your model inside of adaptive, this is what I'm speaking to, so that one, you can see the impact on the P&L. In this particular demo model, we don't have it flowed all the way through to balance sheet ratios or, thinking through some metrics there. But that would be what I would typically suggest, my customers think through if they were wanting to do this type of, high-level scenario analysis. I see generally my clients kind of across the board, looking to do a lot of times a scenario analysis, through versioning and still doing detailed plans. But if you build something like this out, you can do a quick and dirty analysis inside of adaptive and kind of get a picture of what your P&L might look like. So, the big drivers here are what's the percentage change against my baseline budget. So this is assuming a 25% increase, 20% increase, this scenario, my cost of sales increases at a lower ratio, and just walking through, the differing scenarios inside of adaptive. I have the ability to adjust these percentages over time inside of adaptive. But then ultimately, adaptive has its own reporting engine, which I can then use to generate a report that honestly just is showing me the detail of what those results would look like. And so I can quickly see, based on the impacts that I put into my model, what my baseline looks like versus scenario 1, scenario 2, over time. And so this helps me identify the impacts. And then if you're also, accounting for the associated balance sheet or cash flow impacts, you can reflect that here as well. And so being able to quickly do these inside of an instance, is something I would encourage most people to consider before they, especially if they're just trying to come up with high-level plans. Now, moving forward from that, the ability to do detailed planning is, another capability that's inside of adaptive that can, be impactful across your personnel and vendor level models. And well, zero-based spend models, and that's something I'm going to turn it over to Tiffany to talk about here. And when you build these out, it's not just used for one scenario, meaning an adverse scenario. It can also be used, in an advantageous scenario. So a lot of times the functionality you build isn't just useful for one occurrence. Adaptive is flexible and lets you, apply that, in multiple different ways inside the model. Turn it over to you, Tiffany.
All right, great. Hello, everyone. My name is Tiffany. What I will be demonstrating for you today is not only scenario planning during a time of disruption and abundance, but I'm really going to be focusing on detailed scenario planning and reporting for those items. So first thing I have showing here is a assumption sheet that is based on a company-wide workforce planning. And what that is in more simple terms is going to be a global input sheet where I'm going to make inputs that are going to impact the rest of the model. The great thing here is that I can make a couple of changes, press save to it, and it's going to trickle into all of my personnel planning sheets, as well as make an immediate impact to my financial statements. So any of those accruals, that's going to impact the balance sheet. So those are going to be updated, and then the expense accounts, those going straight to the P&L, so that would be impacted. And what I'm doing here is just making a couple small changes that are going to make really big impacts. So let's talk about that from what are some of the best practices for modeling. One of the things that we are seeing coming out of our clients, like some of the feedback that we're receiving from them, is their need to lower their FTEs, their delayed and bonus payout, adjusting 401k match percents, maybe temporary pay decreases, eliminating new hire headcount, or time shifting that piece. From this particular sheet, those are some of the things that we can accomplish just in one location. And it is part of our best practices to build these components into your personnel model, presuming that you do plan for commissions and bonuses and raises. Okay, so with that in here, we've got a standard raise percent. So what this illustrates is the amount that raise is anticipated to be for the year. If you wanted that raise percent to change, so in times of disruption, maybe it goes down to 0% or even goes into a negative figure where you're going to reduce salaries across the board by the same amount starting in the same month. You have the ability to do that by inputting the rate as well as using the standard raise month. So we can use a standard raise month to allow us to set the date for when raises would be calculated. If you're wanting to shift that from an earlier part of the year to later in the year, changing that raise month code. So this is a 4, so it's used for April. And if we were to switch it to 12, that means it would insinuate that, or it would calculate that it would calculate raises beginning in December, or if it needed to just be blank, go ahead and take that out for the whole year. You would be able to eliminate that as well. So in this case, what I'm going to do is I'm just going to shift this to a 12. We're going to move that from a assumption of April to December. And I actually don't have to make a physical input into every single field. What I could do is use this neat little feature of copy forward. I'm going to use advanced. And what I want to do is I just want to go through the end of the year. So I don't want to necessarily impact any long range planning that I have for the future years, because there's I'm a positive thinker. Things are going to go back to normal for next year. So we're just making this adjustment for this year. Also in here, 3% raise, if you wanted to decrease that, so let's say that we're only going to go to 1.5% instead of the traditional 3%, what I could do is I could do the same thing where I can just advanced and I can copy it to the end of the year, and then it takes that amount and pushes it to the end of the year for me. I'm going to press save. And then those changes have now become official. So it was really that simple. So if you're sitting in a meeting with your teammates and you're talking about some of this what if scenario planning that you can do where you can make changes immediately, not only from an adaptive standpoint, like where you can quickly make changes, but as an employer, when you're thinking financially, what are some of the financial levers that you could pull right this minute that would be able to save you perhaps a few dollars here or there. Moving your raises from one point in time to another is definitely one of those. Decreasing the raise percent that was previously planned is another method. We also talked about commission payout and bonus payout. So these are going to be triggers. This is assuming that the commission payout will be at 82% and the bonus payout will be at 75%. In this scenario, commissions and bonuses are paid out monthly. That's not always reality, but that's okay. So much like the standard raise month, if your commissions were going to be paid out maybe on a quarterly or going to be paid out annually, same with bonuses, you would be able to toggle that time period. You can have the same type of assumption account that we have for the raise month that would help to manipulate those triggers where you could have that setting made for you. We also have, so the attainment percentages, so those are just as critical because you have the ability to change that amount that will be considered for commission. So if you know that sales are going to decrease, but you want to make sure that you are taking care of your sales team that's continuing to work. So maybe you don't want to go all the way down to 0. You want to be able to keep them motivated. but 82% might be a little bit high versus what your sales are. So you would be able to take that down, but then you also have the ability in times of abundance to take that up. So thinking about how you can use these levers for both good times and for bad. So these become functions that live within your model that you get to use for the foreseeable future, and they have that multifunctional use, right? So in this instance, we're going to take this up to 110% because that's just the fun. I don't want to be complete downer today. We're going to do advanced, and I'm going to copy to the end of the year again. So that way I'm not manipulating any of the components that are here for my long range planning. All right, so I'm going to go ahead and press save. And again, just a couple of clicks and I've made these adjustments relatively quickly, and there's not a lot of additional manipulation that has to be done because these elements now flow into my personnel model and are immediately impacting all of the details that are there. Right. So the other thing that I want to show you guys that is also part of that detailed scenario planning has to do with a little dimension called scenario. So those of you that are familiar with adaptive know that you can add additional dimensionality and use that dimensionality among several different sheets. One that Dallas demonstrated for you a few minutes ago that show you some of that high level scenario planning. Well, we can still use that dimensionality to use it for more detailed scenario planning as well. And one of the things that we could do is tag those dimension values with an attribute, which allows us to be able to get more use out of the dimension values and add more detail behind them. So what I did is I added an attribute that allows me to tag the scenarios, which right now have very generic names, with what I want to, how I want to differentiate these as baseline, some emergency attrition, and some growth initiatives. Again, because I definitely don't want this to be all negative and just thinking about all the things that have happened in this time of disruption right now, because we are going to see everything come back. All right, so those attributes are managed through here. And as soon as I change one of these, it flows through into the dimension. So it does minimize the number of steps that have to be done to maintain this data, which is great. Right. So into my scenario flag. So in addition to having the scenario names and what they mean for us, I need to be able to turn them on and tell it what I need to do. I'm going to circle back to this in just a second. So what I did is I've actually tagged all of my data here with the scenario. I'm using scenario 1, scenario 5, and baseline. It sounds kind of random, but when we were playing with it earlier, it made sense. All right, so scenario 5, baseline, and scenario 1. All right, so baseline in this fictional view, we're thinking of this as stuff that keep the lights on. So these are the vendors that we have to keep paying in order to maintain business. And then we've got scenario 1, which are going to be the ones that we need. But so this is going to be part of that emergency attrition. So that's going to be an adjustment that we make if we've got to suddenly turn things off. And then scenario 5 is part of our growth initiative. So as we start growing, we're gonna need to have these particular vendors. And notice that in here, aspirin is one of them. So I thought that was kind of cute. All right, so those scenario flags. So this is where I would go in order to take all of those items that I have tagged and to turn them off. So I could quickly do some what if scenario planning. What's really cool about this, like in addition to how we're talking about it today, you could use it as the corporate team. I've seen a number of clients use this, and what they do is they have this scenario planning that allows them to be able to utilize this concept of versioning without actually having to create new versions. It's nice in a couple of different ways. One, if you have teams that don't have access to the administrator panels, they don't have the ability to create their own versions, but they want to be able to turn things on and off so they could, perhaps they're trying to achieve a specific EBITDA number for themselves. What they could do is tag each of their expenses, much like we have in this vendor contract sheet with the scenario, and then they can come into the sheet, just as I'm going to demonstrate in just a moment, turn things on and off. And then from another perspective, I've seen corporate teams that Perhaps you have a number of budget managers that submit data to you. You're lucky enough to get them to do it in Adaptive, but you've got a couple adjustments that you have to make. So you've made a copy of your budget. You're trying to do your own what if scenario planning, because maybe the upper management hat or your upper management has asked you to get to a specific EBITDA number, and you're trying to determine what pieces that you could cut. So these scenarios, instead of having generic names like we have them today, you could actually name them like high, medium, and low. And perhaps items as they get submitted, they get tagged with a high, medium, and low instead of a scenario 1, 2, 3. And that allows you to be able to come into the scenario flag sheet without asking anything more of your budget managers. You can turn off the items that are low, maybe even your medium, high, and maybe even have like another level, like extremely high, important, where you now can do your own what if scenario planning without asking your budget managers to go back and redo work. Because often they're in the field, we need them making money. So having them come back and work on budget data is sometimes a little bit difficult. All right, so let's get to it. So what we would have to do in here is just submit a number. So I'm going to use a scenario 1. So this one, I want to turn it off for each one of these months. And I'm actually just going to, instead of typing that all in, I'm going to copy it forward to the end. And then on my scenario 5, I'm just going to do this starting with June, and I'm going to copy that forward to the end. And I'm going to press save on that. And that's going to impact everything that's happening here based on these scenario codes that I have. And then in here in my workforce planning, I have them as well. And I've even brought in this attribute, which allows me to see what the baseline is. So maybe my group that's doing the reviewing personnel data needs a little bit more detail regarding the scenario. And so now that they can see what the attribute details are. Right, so each one of these have been tagged, and once we've turned on these scenario flags, they are now live, and then it allows me to pop over here to reports. So in this report, I have it pre-built, and I've got the working budget, which is a version before we made any of these changes, and then we made the changes today in the working budget scenario. So what I'm going to do is I'm just going to click this little button here, and it's going to run, and what it's going to allow me to do is see the difference between what's occurring in that working budget and then those changes that I just made. So see the big drop that we made to our expenses just by toggling a few figures, changing the raises to be towards the end of the year, reducing what the raise amount was, changing what our commissions plan was, and then even turning off certain headcount. And we were able to do that by tagging individuals with a scenario, and those individuals that were tagged with that scenario, and when we put the flag in, that 1 represents that we want it to calculate to 0. So all the head count that's associated with those heads now goes to 0, in addition to the changes that we made to the bonus, right? And so very quickly, you can see how those few clicks of buttons have changed the financials. All right, guys, so that concludes the demonstration that I have for you. So I'm going to pass it back over to Mike.
Excellent. Thank you so much, Tiffany and Dallas, for providing us with some insights into scenario planning. We do, hope that, all of the information that we covered today was highly beneficial, and, always happy to answer any and all additional questions. We did have a couple questions come in here via the Q&A and also just a direct message. I would like to make sure that we do cover these with a few moments that we do have remaining. We'll be going for about another 4 minutes. The first question that came through was, how difficult is it to add an attainment percentage for bonuses or 401ks to an existing model that doesn't have it? I don't know, Dallas or Tiffany, who would like to take that one?
I'm happy to take it. So it's not hard at all, especially, you know, if you're just tying it into if you're just modeling your bonus at 100% attainment, what you're probably going to look to do is just build in an assumption, and it's really thinking through what that assumption looks like. So if you're thinking about an attainment percentage, does it differ across different bonus plans? Does it look different that way? Or does it look different across bonus plans and region? And thinking through that, and then that would drive how you add that in into a model. But it's very easy to add in, and it would just be, you know, adding in a couple accounts, and then also adjusting the logic in a modeled sheet, most likely to accomplish the desired outcomes.
Excellent. Thank you, Dallas. And we did have one other question that came in that I just wanted to make sure that was addressed across the entire everyone attending the webinar today. Are scenarios only available in total companies?
Happy to also answer that. So as of right now, if you were to think about the way adaptive works, and the reason the scenario planning is helpful is that it actually lets you, if you could make it available across the company, meaning not just in the top level total company, you could actually make it available on a level by level basis, and each user would have the ability, if you made it in that scenario available, that they could go and turn on or off the different flags. It's just changing the modeled sheet logic behind the scenes to make it possible, which actually ties into Dan's question here as well on the Q&A, but it's really how you would change that modeled sheet logic so that you could actually accomplish the desired objective. And so what I'll do is I'll hop in real quick here and just show what that formula looks like. But by doing that, you actually can turn on capability, you know, that is on the roadmap of, you know, version, you know, user versions inside of adaptive, but you can actually kind of get that ahead of time by using this type of capability on a level by level basis inside of adaptive as well. And you can get it now. All right, so let me just share my screen. Everybody should be seeing, so if we were to look at this, we had a couple different sheets where we turned this on or off. And I'm going to kind of show what I consider, you know, so we'll show the two different sheets. But the first one we're going to look at is this vendor contract sheet. And this is probably the simplest example of how this works. So this is just a standard sheet that you saw where you have vendor and you have the ability to tag with different scenarios. So you have to make sure that scenario dimension exists inside of the sheet. And if you were to look right here, this is the time span. This is me keying in my values over time inside of that sheet. And then as a general best practice inside of adaptive, anytime I build a time span sheet, I go ahead and build a calculated account that exists within that sheet. That way I can do these types of fluxing by scenarios. And this would actually be the account I would tie into my P&L. So if we were to look at this, this is telling the model sheet to look at first if there's a scenario flagging sheet that you guys saw earlier, and we're telling it to look at the whole company, and then we're telling it to look at whatever scenario is on the individual row inside of that sheet. So we're telling it to look at that, and then if there's not a flag populated, or if there's a flag that is populated, meaning it's a value greater or less than 0, it populates a 0. Otherwise, it populates a 1, and we get the spin to come through. And so this is how you would handle it inside of a standard modeled sheet around vendor spend, and then inside of a sheet for personnel. One moment. Workforce planning. Really, there's a couple accounts that are typically your drivers inside of your personnel model that if you fix it there, it's going to fix it across the model. So if we look at this right here, you know, this is, you know, the headcount account in this particular model. The only thing we did in this scenario was we just took that original headcount calculation and we just added in that same scenario if statement that you saw earlier so that we could capture this. Now, if I wanted to also do something with the scenarios where in the personnel environment, maybe I was flexing different scenarios to be different FTEs, maybe I also have an FTE percentage that I'm building in. So not only is there just a flag to turn on or off spin, maybe I'm moving a whole swath of my employee population, you know, to halftime or what have you. And you could also use that for variability for overtime and things like that inside of a model. Okay. saw another question pop up. Let me take a look.
Correct. And I can read it aloud for the audience and also for audio purposes of the recording. As you're getting ready to set that up, Dallas, the question is, why would an assumption such as salary increase month be set up separately in each month of the year? And then the follow-up question to that is, shouldn't it be set up just once? If the user entered under January, that the increase would be in December, and then entered under June, that it would be in March. For example, what result would they get? Question mark.
Okay, so in a typical scenario, as to how I would build a model, I would most likely only have you input that percentage in the month of the increase. In the case of this particular demo model, it has both a month trigger, so I'm inputting the month, and then I'm also inputting the percentage. In that scenario, you actually need to input both the month and the percentage, correctly so that it triggers. Typically, the input would be the same across the year. If you had marginal increases across the year, you might put, let's say you had an underrun or you had a small percentage of, the total overall pay increase hit in, March of this year, and then you put like 75% of it at the end of the year, you could input that in 2 different months and affect, the person's pay total OTE, differently that way inside of a model. It all is driven by how a model might be built. Hopefully that answered the question.
Excellent. Well, we have gone past our time. We're happy to address any and all questions that might pop up after the webinar. But, as far as today is concerned, we'd like to, again, thank everyone for attending. Dallas, Tiffany, appreciate your time here today. And please, everyone, be healthy, be safe, and we'll have a good day. Thanks so much.